Last week, the largest asset manager in the world quietly told investors something they never expect to hear. You can't withdraw your money. Not all of it anyway. Roughly half of the withdrawal requests from one of BlackRock's private credit funds were denied. Now, on the surface, that might sound like a small technical issue. Funds sometimes limit withdrawals. Markets fluctuate. These things happen. But when investors suddenly can't access their money, it usually signals something deeper. Because the market this fund operates in isn't small. It's part of a financial system that has quietly grown into a $3 trillion industry over the past decade. A market that, in some ways, is now larger than the subprime mortgage market that helped trigger the global financial crisis in 2008. And yet, almost nobody outside of Wall Street is paying attention to it. Right now, the world is full of louder headlines. But beneath those headlines, something important may be happening inside the financial system. Because when liquidity starts disappearing, problems that once looked manageable can suddenly become very serious. Today we're going to break down what private credit actually is, how it grew so fast, why cracks may be starting to appear, and whether this is simply a normal market cycle, or the early stages of something much bigger. But the withdrawal limits themselves are not actually the most interesting part of this story. The real issue is why those limits exist in the first place. And once you understand that, you start to see a structural weakness that very few people outside the financial industry are talking about: how the system was built. To understand how we got here, we have to go back to what happened after the 2008 financial crisis. That crisis forced governments and regulators to completely rethink how banks operate. Banks were required to hold more capital. Risk limits were tightened. Regulatory oversight increased dramatically. From a financial stability perspective, these changes made sense. But they also had an unintended side effect. Banks became much more selective about who they were willing to lend money to. Many mid-sized businesses suddenly found that the financing they used to rely on was no longer available. Factories still needed to expand. Retail companies still needed working capital. Technology firms still needed funding to grow. But the banks that once provided those loans were no longer interested. And whenever a gap appears in finance, someone eventually steps in to fill it. In this case, that role was taken by an industry that most people had barely heard of at the time: private credit. Private credit funds raise money from institutional investors like pension funds, insurance companies, and wealthy individuals. They then lend that money directly to companies. In many ways, it's simply lending, but without a traditional bank in the middle. At first, this seemed like a positive development. Companies gained access to capital. Investors gained access to higher returns. The system appeared to work. But the story becomes more complicated when we look at another industry that was expanding rapidly at the exact same time: private equity. The growth engine behind the market. Private equity firms buy companies using large amounts of borrowed money. This strategy is often called leveraged buyouts. The basic idea is simple. Investors provide some capital. Borrowed money provides the rest. The company is acquired, improved, and eventually sold for a profit. But the entire model depends on one critical ingredient: debt. And as private equity expanded rapidly over the last decade, it needed a constant supply of lenders willing to finance those deals. Private credit funds became that lender. So the two industries grew together. Private equity needed financing. Private credit supplied it. As long as borrowing costs stayed low and businesses continued performing well, the system functioned smoothly. But that wasn't the only force pushing private credit to grow. Investor demand played a huge role too. Why investors poured money into it. For most of the last decade, interest rates around the world were extremely low. Government bonds paid very little, Savings accounts paid almost nothing. Traditional fixed income investments struggled to generate meaningful returns. Investors began searching for alternatives. Private credit offered exactly what they were looking for. Higher yields, sometimes 8%, sometimes 10%, occasionally even more. Compared to near zero returns elsewhere, that looked incredibly attractive. But there was another reason investors liked these funds. Unlike public markets, private credit loans are not traded daily. Their prices don't fluctuate every minute like stocks. That lack of visible volatility created the impression that the investments were stable. Money began pouring into the sector. Funds grew larger. More loans were issued, and the industry expanded at a remarkable pace. Today, estimates suggest the global private credit market has reached roughly $3 trillion. But rapid growth in finance often raises an important question. Are risks building beneath the surface? Because there's one structural weakness in this market that only becomes obvious under stress. And it has to do with something called liquidity, the transparency challenge. Before we get to liquidity, there's another issue that deserves attention: transparency. Public markets provide constant price signals. Stocks trade daily. Bonds trade regularly. Analysts publish research. Investors can observe prices and trends in real time. Private credit works very differently. Loans are negotiated privately. Terms vary from deal to deal. Information is often shared only with a small group of investors. And because these loans don't trade on open markets, their true value can be difficult for outsiders to assess. This doesn't necessarily mean the market is unstable, but it does mean risks may remain hidden longer than they would in public markets. And when problems eventually appear, they sometimes surface quickly. The interest rate shock. For many years, low interest rates helped support the private credit boom. But when inflation surged globally, central banks began raising rates aggressively. And this is where things started to change. Many private credit loans are structured with floating interest rates. That means when central banks raise rates, borrowers automatically face higher interest payments. Imagine a company paying $4 million a year in interest. If rates double, that same company might suddenly owe $8 million. The debt hasn't changed, but the cost of servicing it has doubled. For companies with thin margins, that kind of increase can become extremely difficult to manage. And when enough companies struggle at the same time, defaults begin to rise. Recent data suggests private credit defaults are now climbing toward record levels. But rising defaults alone don't explain why investors suddenly can't withdraw their money. For that, we need to look at the structural weakness that many analysts worry about: liquidity mismatch. The liquidity problem. Here's where things get interesting. Many private credit funds allow investors to request withdrawals periodically. But the loans inside those funds are often long-term. 5 years, 7 years, sometimes even longer. This creates something known as a liquidity mismatch. Investors may expect access to their money within months, but the underlying assets may take years to mature. Under normal conditions, this isn't a major issue. Withdrawals are limited. New investors replace old ones. Cash flows remain balanced. But when many investors request their money back at the same time, the system becomes strained. Funds may not have enough liquid assets available. Selling loans quickly may require accepting steep losses. So instead, funds sometimes limit withdrawals, which is exactly what recently happened. And when investors see withdrawal limits appear, it naturally raises a new question. Could this spread further? Could this become a larger crisis? At this point, the obvious question is whether private credit could trigger a crisis similar to what happened in 2008. The honest answer is that nobody knows for certain. There are reasons to believe the financial system is more resilient today. Banks hold more capital, regulation has improved, and financial institutions have learned lessons from past crises. But there are also important differences. Private credit loans often finance operating businesses. If those businesses struggle, the consequences extend beyond investors. Employees may lose jobs, suppliers may lose contracts, local economies may feel the impact. And because much of the market operates privately, the full scale of potential risks may only become visible during periods of stress. The bailout question. Another question inevitably arises during moments like this. If the market runs into serious trouble, should governments intervene? Some argue that investors knowingly accepted the risks involved. Allowing losses would reinforce market discipline. Others argue that if financial stress spreads far enough, intervention may be necessary to protect the broader economy. This debate has appeared in nearly every financial crisis in modern history. And the answer is rarely simple. Because once financial instability begins affecting real businesses and real workers, the pressure for action can increase quickly. Final thoughts. So, is private credit about to crash the global economy? It's far too early to say. Markets move through cycles. Periods of rapid expansion are often followed by periods of adjustment. But when a multi-trillion-dollar market begins facing its first major stress test, when defaults begin rising, and when investors suddenly encounter limits on withdrawals, it's worth paying attention. Because financial crises rarely begin with dramatic headlines. They usually start quietly, with small cracks that most people ignore, until eventually those cracks become impossible to overlook. And right now, some analysts believe the private credit market may be entering exactly that kind of moment. The next few years will reveal whether this industry represents a stable evolution in modern finance, or the next hidden fault line in the global economy.